Goldman Sachs is launching an aggressive recruiting campaign to expand its asset management business. Goldman, of course, is one of the top performing financial stocks, rising so far 113% year to date. Bloomberg's Greg Miles joins me now with more on that story. Greg?
Mark, in fact, analysts and investors telling me that now is the time to strike for Goldman Sachs. With the rest of the asset management market in disarray, Goldman Sachs can use its peerless reputation for making profits and talent for avoiding disaster to attract billions of dollars in new money now. Here to talk with me about that is Jeffrey Harte, analyst at Sandler O'Neill, coming to us from Chicago. Jeffrey, welcome.
Nice to be here.
Let's talk about this first. Now, is it the ideal time to strike for Goldman?
I think this is a pretty good time to be looking. Yeah, you've had some disruption in the asset management businesses in general because asset values have declined so much with the credit freeze. So, whenever you get some disruption, it's a good opportunity for someone like Goldman to come in and kind of buy when others are exiting. So I think this is actually a pretty good time for them to be looking.
One thing that strikes me is Goldman Sachs right now ranks 17th in the world in terms of size and asset management with about $844 billion in assets. That puts them less than half the size of giants like State Street, Fidelity, AXA Group, etc. How do you beat these guys? Could it be a mistake?
Well, and Goldman's big. I mean, number 17 is definitely a scale player, but there's a lot of room to grow. Specifically, there are some holes in their product offering. They really don't have much as far as a passive or index offering, which most of those big names you mentioned do have. But secondarily, in a lot of their active products, both fixed income and equity, I mean, they've got the infrastructure there. They're managing the money, but they could probably double their assets under management without having to add a lot of additional cost to it. So, I mean, they're large player, but I think there's definitely room for them to grow and move from 17 to certainly in the top 10. And
I'm told, Jeff, that this area can be extremely profitable, although perhaps not as profitable as their high-risk proprietary trading. But Peter Sorrentino, the fund manager at Harte Asset, telling me you can get 60% pre-tax profits in asset management. That's pretty darn good.
Yeah, it's a very profitable business. I mean, the one thing for Goldman Sachs, and for them it's a profitable business as well, but it's only about 10% of revenues historically, so it's not a very big business for Goldman Sachs. But definitely, if you can deliver the performance, which is often the challenge in asset management, and you have the distribution to get your products out to investors, which is definitely a Goldman Sachs strength, this can be a very attractive business with some pretty good long-term growth prospects as well.
One thing that struck me is over the past few years, this asset management business has grown to a much larger share of the company's net revenues. But then since 2008, it's plunged from about 20% of net revenues at Goldman to about 6-7% in the latest quarter. Should we be worried? Well, why the decline?
Well, the big driver of the decline there is Goldman Sachs is a very large alternative asset manager, managing hedge funds and things like that. And the fee structures with those type of products have what we call incentive fees, or if you perform really well as a manager, you get to keep a portion of the returns. So if you go back to when it was 20% of revenues, that was a year where they had very strong returns and had large incentive fees. And now we're kind of getting back to, I think, a normal environment where, with the markets down as much as they've been, there's not much for incentive fees being kind of drawn anywhere across the industry. So I think from a normalized type perspective, I look at it as being something close to 10% of revenues for Goldman.
Jeff, we got about 45 seconds left. Acquisitions. You're skeptical that they could find any acquisitions that would be attractive. They said they might look at it. Why not attractive?
Well, the big problem they face is brokers, including Goldman, traded about 10 times forward earnings. Asset managers tend to trade at about 20 times forward earnings. It becomes a very expensive prospect to go out and buy. But also when you buy, you risk whether the cultures will mesh, whether you'll be able to retain people. So if you can actually build it yourself, I think it's actually an easier thing to manage and a much lower cost avenue for growth.
How about 20 seconds left? But for $4 billion, you can get Legg Mason, which has $900 billion in assets. You get Bill Miller for free. That's pretty cheap.
But it all depends how much currency is that going to cost you, and are you going to be able to keep Bill Miller and all the employees like that? And will that franchise fit into the Goldman Sachs kind of model? I mean, it's a very unique culture at Goldman Sachs. So there's opportunities out there, but generally speaking, Goldman's been pretty reluctant to actually pull the trigger on M&A in the asset management space.
Jeff, we got to go. I want to thank you very much for your time.
Nice to be here.
Here you have it, Jeffrey Harte at Sandler O'Neill. Back to you, Mark.
Greg Miles and Jeffrey Harte, thanks.